grow your money faster than the average investor? 3 SGX stocks are beating the market right now, and most people don't even know about them. Let me show you what everyone else is missing. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. Think of the Singapore stock market like Orchard Road. Everyone knows the big shopping malls, but some of the best deals are in the smaller shops that tourists walk right past. That's exactly what's happening with these 3 companies I'm about to share. Our first hidden gem is NanoFilm Technologies. They make special coatings that protect everything from your phone screen to car parts. Just like how a good screen protector keeps your phone safe. What's cool about NanoFilm is their focus on making things last longer and perform better through advanced materials. Think of it like giving everyday products a super-powered upgrade. We're talking about everything from smartphones to cars and even medical equipment. Now, numbers don't lie, and NanoFilm's financial performance has been pretty impressive. They raked in $60 million in just one quarter, a solid 10% jump compared to the same period last year. That's not just revenue growth, it shows they're doing something right. But what's even more important is their ability to hold on to more of that money as profit. This tells us they're managing their costs effectively and running a tight ship. This is a crucial metric to watch because it shows how efficiently a company turns sales into actual earnings. Now, here's where things get really interesting. Singapore itself has expanded its landmass over the years, right? NanoFilm is taking a similar approach, expanding its reach beyond Singapore's borders. They're not putting all their eggs in one basket. They're strategically building new manufacturing facilities in Vietnam, making inroads into the Indian market, and even expanding their presence in Europe. This kind of geographical diversification is a smart move because it reduces reliance on any single market and opens up new avenues for growth. It's like planting seeds in different gardens. If one has a bad season, the others can still flourish. This expansion is a testament to their ambition and confidence in their technology. It also positions them to tap into new customer bases and potentially become a global leader in their field. All right, folks. Let's dive into Polo Marine. Now, don't just think of them as your average shipping company chugging along the Singapore Strait. These guys are playing a much smarter game. They're setting their sights on the booming clean energy sector, specifically offshore wind power. Think massive turbines out at sea, generating clean electricity. That's where Polo Marine sees its future. While their total earnings saw a slight dip to $123.5 million this year, what's really interesting is that their profitability has actually improved. This tells us they're becoming more efficient and managing their costs effectively, which is a big plus. They're not just making money, they're making better money. This is a crucial point to consider. Top-line revenue is important, but a company's ability to turn that revenue into actual profit is what truly matters for long-term sustainability and growth. This shift towards higher profitability could indicate strategic moves like focusing on higher margin projects or streamlining operations. And here's another thing that caught my eye. Polo Marine has a healthy $35.8 million sitting in their cash reserves. In the business world, cash is king. Having a substantial cash buffer like this gives them a lot of flexibility. They can use it to invest in new projects related to their clean energy push, weather any unexpected economic storms, or even consider strategic acquisitions. This financial stability is a huge advantage, especially in a dynamic and evolving industry like renewable energy. It shows they're not just chasing trends, they're building a solid foundation for future growth. Remember, having cash on hand is a sign of financial health and can be a strong indicator of a company's ability to navigate challenges and seize opportunities. It's like having a well-stocked emergency fund. It gives you peace of mind and the ability to act quickly when needed. Let's dive into UMS Holdings, a company that's quietly powering our digital lives. They're not making the flashy gadgets you see in stores, but they're crafting the essential components that make those gadgets tick. Think of them as the unsung heroes behind the scenes, producing the precision parts needed for semiconductor manufacturing. These semiconductors, or computer chips, are the brains of every electronic device we use, from smartphones and laptops to cars and even household appliances. With the global demand for these chips constantly growing, UMS Holdings is strategically positioned to benefit. In fact, they're projecting an additional $30 million in revenue next year, a testament to their strong market position and the increasing demand for their products. This growth reflects the overall expansion of the semiconductor industry, which is projected to reach hundreds of billions of dollars in the coming years. It's not just about today's technology. It's about the future of AI, the Internet of Things, and countless other innovations that rely on these tiny but powerful chips. UMS Holdings' success isn't just a lucky break. It's built on years of expertise and a focus on precision engineering. They're not just making any parts. They're producing highly specialized components that require intricate manufacturing processes. This specialization creates a barrier to entry for competitors and allows UMS to maintain a strong foothold in the market. When you consider the sheer volume of chips needed to keep up with global demand, you start to understand the scale of UMS's operations and their importance in the tech supply chain. Their projected $30 million increase in sales isn't just a number. It represents a significant increase in production and a growing contribution to the semiconductor ecosystem. It's a clear indicator of their resilience and ability to capitalize on the ever-evolving technological landscape. By focusing on this critical niche, UMS has carved out a valuable space for itself in the global tech market. So, before you jump into investing in these smaller companies, remember they're not like the big blue chip stocks you see dominating the headlines. These smaller market cap companies are more like the heartland shops compared to the Orchard Road giants. They might not have the same volume of daily trading, which means buying and selling shares can take a little more time. This is what we call lower liquidity. You might not always find a buyer immediately when you want to sell or a seller when you want to buy. This isn't necessarily a bad thing, but it does mean you need to approach these investments with a longer-term mindset. Think of it like planting a tree. You don't expect it to grow into a towering giant overnight. It requires time, patience, and consistent nurturing. Similarly, these smaller companies need time to develop, execute their business plans, and potentially grow into larger, more established players. According to the Singapore Exchange, SGX, as of December 2023, there are over 600 companies listed on the Catalyst board, which is specifically designed for these smaller, high-growth companies. This shows the breadth of opportunities available, but also emphasizes the need for careful research. Now, because these companies are smaller and often younger, they can be more volatile than their larger counterparts. Volatility is just a fancy word for how much the price of a stock can go up or down. Imagine a small boat in choppy waters versus a large cruise ship. The small boat is going to be tossed around much more. That's similar to how smaller companies can react to market news or changes in the economy. This higher volatility also means there's potentially higher risk, but it also means there's potentially higher reward. You've got to be prepared for some ups and downs along the way. Regularly reviewing your investments is crucial. It's like checking on your planted tree to make sure it's getting enough sunlight and water. You need to stay informed about the company's performance, industry trends, and any news that could impact your investment. This doesn't mean checking the stock price every 5 minutes, but rather conducting regular reviews, perhaps quarterly or semi-annually, to ensure your investments are still aligned with your overall financial goals. Remember, investing in smaller companies can be a great way to diversify your portfolio and potentially achieve higher returns, but it requires patience, due diligence, and a long-term perspective. Many of you were curious about how to actually pick good dividend stocks on the SGX. Well, it's not just about chasing the highest yield, that's for sure. You got to look under the hood, like checking the engine of a car before you buy it. One crucial thing is to check the company's dividend payout ratio. This tells you what percentage of their earnings they're giving out as dividends. A consistently high payout ratio might seem attractive, but it could also mean the company isn't reinvesting enough back into the business for future growth. Also, remember to look at the company's history of dividend payouts. Have they consistently paid dividends over the years? Have they increased them? A long track record of consistent or increasing dividends is a good sign of a stable and mature company. It's like a reliable old friend who always comes through. Now, let's talk about where to find this info. The SGX website is your best friend here. It's packed with company announcements, financial reports, and all the nitty-gritty details you need. You can find annual reports, which are like the company's yearly report card, and quarterly reports, which give you more frequent updates. Remember, doing your homework is key. Don't just rely on what you hear from others, even from yours truly. Do your own research. Compare companies within the same industry and understand their business models. This is especially important when considering dividend investing, as discussed in my video, SGX Dividend Truth, Powerhouse or Time Bomb. Understanding the underlying financial health of a company is crucial before investing in their dividends. By actively tracking financial reports, understanding revenue streams, and keeping an eye on industry changes, you'll be well on your way to making smarter investment decisions, especially when it comes to navigating the SGX dividend landscape.